Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing. Good morning, my name is Aaron Edwards. Welcome to the W2H YouTube channel. Time for our weekly market update, and it's March 11th, 2025, USDA report day. It's time for our monthly USDA report, so we're going to get into that in just a minute. But as we always do, before we start talking about the markets, we want to just start with call to action. We have a heavy bias towards action. What should our customers and what should farmers be doing? So let me just get that pulled up here so we can go over the actions. All right, so we have quite a bit going on from a recommendation standpoint. Let's just clip through those, focus on corn here. So we are going to, the first thing we're going to do is focus on quarter four. So that was quarter four, not of the next crop year, but of the 24, quarter four of 2024. So we are going to re-own 40% of quarter four corn bushels. That should say bushels. By buying July 25. So if you remember, we made our quarter four sales when we needed to make them, and then we re-owned them and we got some profits on them, but not very much. We didn't ride it all the way to the top. Prices have fallen. We're actually kind of similar to where some of those positions were exited. So we're going to step into some 40%, not all of them, but we're going to step into some long positions again. And the thought is, goes up again, we can, on a spring rally, we can benefit from that. We're not going all in on those. We're just starting with 40% right now. So you should have, if you've been following the recommendations, you got out of your quarter four sales, made some profits, market went up a little bit more, it's come down, we're stepping back into 40% of those. And depending on how the next couple weeks trade, we'll probably increase that position, but we got to take this one week at a time. Next action item, we're going to exit the hedge for 35% of quarter one corn by buying back May 25. So if you remember, we had a 25% hedge of quarter one corn bushels done in May. That was real close to $5, depending on where you got in, a little better, a little worse. And then that's 25%, and then 10% we were in March, and then we rolled those to May. So altogether, you should have an active hedge on 35% of your quarter one corn bushels, and we are going to exit that this week. Depending on exactly exit and entry point, the net of that should be a pretty good profit. But we're going to basically get out of our sold positions, and that brings us to our next point. We're going to sell 20% of quarter one corn bushels. We started off when we made sales, just spacing out sales. We got up to 40% of our quarter one bushels priced, and then we layered in another 35% with hedges. Now we're taking profits on those hedges, and we still have 60% of our quarter one bushels to sell. So just real simple math, we have basically 3 weeks left in March, and so we're just gonna layer in 20% at a time with those quarter one bushels is the plan. Now, if the markets tank, we might be selling it and re-owning it, but we've got some time to figure it out. But for this week, we're gonna exit the 35% hedge, right, of our quarter one bushels, and we're gonna go ahead and sell 20%. So we're not selling 100% of the hedge we exited, but we are making progress. And the final item, we're gonna exit the hedge for 10% of quarter two corn bushels by buying back July 25. If you've been following the recommendations and you have quarter two bushels, then you would have a hedge on 10% of those, and we're going to step out of those. Again, that hedge was placed close to $5. So depending on exactly where you get in and where you get out, that should be net positive. So that's the recommendation for this week. The next action item that I wanted to talk about is just a little bit of expectations for the report today. I'm not going to go in nitty gritty number by number because my opinion is that USDA reports, they are execution tools, not decision tools. I don't try to outguess the USDA or try to outguess the markets. It's just a very mixed bag as far as expectations. So ending stocks for corn in the US are expected to come down. If you round to the decimal, really no change to beans. World stocks, really no change to corn or beans as expected. So basically the net of everything in the report will not necessarily significantly change ending stocks for corn or beans. Is kind of the market expectation, but slight reductions in corn production out of Argentina, down about 1 million metric tons. Technically expected reductions for Argentina's soybeans as well, but to kind of offset that, they're expecting a little bit bigger crop out of Brazil. So it's kind of a mixed bag, and we're gonna get into the markets of it, but we're in no man's land on the corn market. Beans are weak, and we'll talk a little bit about that. Let me share the screen so we can talk about beans. We're getting to the home stretch here of talking about the Brazil crop progress, but we'll do it a little bit more. We'll at least do it this week. But I am going to go through this pretty fast because this is no longer kind of front and center news. I think green would work well with that. Okay, so this is the CONAB report. I'm recording. Okay. This is the CONAB report of crop progress in Brazil. And what I wanted to point out, first of all, let's just circle this 86%.2. That's how much of the double crop corn was planted based on CONAB's weekly report as of March 10th, a year ago, 2024. And this year we're at, that's the 5-year average, but this year we're at 83%. So we're at like 1 percentage point ahead of the 5-year average. That's good news. About 3 percentage points behind last year. If you remember, I had said by March 10th, that's kind of when the window closes on double crop corn. So if you want to think, Brazil's really big north to south, so you would have to drill in region by region. Are they late? Are they not late? But even if double crop corn planting is delayed, we're only talking about maybe 20% being planted outside of the window. And if you drill into the regions, I'm not even sure it's really that significant of an issue. So Basically, with this report is, yeah, maybe they didn't get to 100% planted, but they're on pace with historic years. They're on pace with historic average. It's right on pace. So there's not really a story on double crop corn anymore, and I don't think there really will be a story. What we might see is on Thursday we get out the CONAB report. I actually think we might see a bump to acreage because the corn prices in Brazil really got friendly here. When corn in the US ran up to $5, the corn in Brazil hasn't come down yet from that. Now, maybe it will collapse, but I actually think on Thursday we might see a bump to acreage out of the CONAB report. So that would actually be a little bit bearish, but not really much of a story. On soybeans, let me get a blue marker here. I think blue would work well. Where is it? There we go. Bingo, blue. Soybeans are also right on pace. If you look at that last year, they were at 55.5%, 5-year average 56%. They're actually a little bit ahead of pace. 5 percentage points ahead of last year, 3 to 4 percentage points ahead of the 5-year average. That's soybean harvest was behind and then it got caught up. Now it's a little bit ahead, just fast and furious. What I would say about soybean harvest is right now, at this point in harvest, is when you kind of hit that logistical wall in Brazil. You may know Brazil doesn't have the railways and the barge traffic and just the roads and the storage facility that you really need to pull these beans out of the market and tuck them away safely without a logistical hiccup. So right now, 60% in, okay, all the contracts have gotten filled, maybe that first 20-30% that's, in and out of the bins, and the first part of harvest, logistics kind of run smoothly. I'm already starting to see pictures and videos of long lines at the port and all that. This is the proverbial trucker strike is right around the corner. Not that there will be one this year, but just the tensions of the logistics, this is where it really starts showing up. So, and along with that, typically a drop in their basis. So Brazilian soybeans, I'm not too optimistic about the price of Brazilian soybeans on the domestic market shorter term for Brazil. But I also think that might translate into just this bearish sentiment of there's plenty of beans in the world, and that's a lot of the weight that we're seeing in the bean market. I think is just that reminder that there's a lot of soybeans out of Brazil. So we will jump into the next parts, but just before we always do, every week we want to go over the philosophy. It's very important for me that we just keep hammering this in because this is critical to the market. So if you watch us every week, maybe this is a part that you're tempted to just push fast forward on, but the simple concepts that keep us disciplined, that keep us on track, that is what really makes a difference in marketing. So we always want to start with the base level grain marketing portfolio, build a plan that works for your operation and combines the market opportunities with your operation. Then that green level, that middle level, that's what we're going to go into now. That is seasonal, funds, technicals. That's really looking at these market opportunities. And then finally, just that call to action where we say, okay, we have a market plan portfolio of kind of how we want to capture these opportunities on your farm. We're tracking the opportunities. Whenever those line up, bingo, we got to take action. It's time to get work done. So let's jump into analysis here. We're going to start with soybeans. And big picture on soybeans. Again, I'm going to kind of move fairly quickly through this next part because we have a USDA report, and probably what will happen is this USDA report will come out Tuesday, Wednesday and Thursday. The market will be digesting it. By Friday, we're probably going to go right back, maybe Thursday, maybe Friday, maybe it'll be next week, but pretty soon we're probably going to go right back to kind of the usual suspects. Well, there's a lot of beans in Brazil. Well, there's the battle for acres. Well, and we are not far from starting to track weather forecasts in the US. So I don't want to overplay the analysis part of this video because, in my opinion, you have this USDA report, then probably a week from now, possibly so many of the headlines will be different, or they will be right back to what they were. What's the ratio between corn and beans, and are there going to be more beans or corn? So I don't want to get lost in the noise of this week, because a week from now, I think a lot of things will either kind of go back, reset how they were before the report, or we'll be talking about new narratives. And I think the chances are that we're going to have quite a bit better picture of opportunities and the dynamics of the market a week from now than we do today. But let's go through it all the same. Let me grab a blue marker and just kind of highlight some points. So one of the things we look at is the funds. And the bad news is last week on the spec funds, let me get this over here to the corner. Beginning on January 7th, we had seen the spec funds in the bean market go net positive. Well, we saw them revert back to net negative on last week's trade. So another way to think about it is spec funds are pushing soybean markets lower. There's a quote that I like. It says, "Research is data with a soul." So you can always tell a number of stories with the same data set, right? But I do want to just put here between 50,000 net short and 50,000 net long. Look at how many weeks would be within that range. 1, 2, 3, 4, 5, 6, 7. We'll just go back to December. 8. So since December, we've had what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. We've had basically 8 of 15 years of 15 weekly updates, weekly reports have been kind of within this range of a little bit net short and a little bit net long. And just for comparison, let's go look up prices of soybeans since December. If we do that same box in blue, there we go. If we just kind of box in the blue since December, that's the price action that we've been looking at, which really isn't, we could almost go all the way back to August. Those highs were there at late September, early August. Let me draw that up there. These highs from late September, if we want to just box this in, this has just been a value area where we've seen spec funds buy a little, sell a little, buy a little, sell a little. And as we approached last time, we approached these December lows, speculators said, "Oh, let me get long." And then they got long, and then they got up to here, and then they said, let me get short, right? I should have done those in reverse colors. And then they're getting out of their positions. So in my opinion, all we're seeing is speculators don't really know if they want to be long or if they want to be short beans. And we go up, maybe within $1 range. We go up to the upper end, and then they say that's a little too much. And then we come down, and that's a little bit too much. And so right now what's happening is, yes, soybeans are pressured downward. How low will they go? And we have spring right around the corner. I do want to point out this right there, that red candle right there, that is a technical reversal. Where in the same session, we took out the previous day's high, the previous day's low, and we closed low. So that is a little bit bleak. It's a key reversal a day before a USDA report. Spec fund. Is it possible bean sell off and get down here? Yes, absolutely. I think that's possible. That's why seasonality plays a big role into what we do, and I'll talk about that in just a little bit. Let's shift gears and close that out. Let's shift gears and go to corn real quick. Okay, in the corn market, we actually saw, let me get green up here, green. Okay, similar story where most of 2024 speculators were net short.
But beginning in November, and I do this almost every week, they started stair-stepping up, and then they really got excited, and it's been a little up and down. Last week, they really weighed down. They exited a significant amount of their positions last week, right? Vroom. Got out of the market. We all know what happened to the corn market during that time. You know, we're going up, got to $5, and we lost. It coincided with the trade war headline, Tariff Tuesday, but I mean, over about 10 sessions, we lost about 15% of the value of corn. Just boom, just completely vanished from market. It's bounced back a little bit. Are speculators going to start betting against corn? Are they going to do what happened in beans, where they really sell this down and it gets really weighty? My hunch is, do you really want to be sold in the corn market coming into the weather risk spring? And I don't think we're going to get speculators completely betting against corn. I don't know that we could have news that's too much worse than, China does 15% tariffs. I mean, sure, we could get tariffs from Mexico. We could get, higher tariffs, but we got really bad news and the corn market got destroyed, and then it's already bouncing back. So I don't know that the speculators are convinced that it's time to just say, we gotta, corn is free and we gotta get rid of it, and we gotta sell it, and we gotta keep selling. But again, same caveat with the beans, we have a USDA report today. So it's very tough to know how much weight to put on the analysis. Now let's look at I want to point out, we're just going to go over the May and the July contracts. And let me mark this up with black. So just kind of to remember just the recommendation. See if I can get it in the corner. We had hedges on, the 35% on the May. Let me just draw this so we can kind of see where we're at. So right around here is where we got a lot of our hedges in. And then depending on the roll, we also were sold in the March and we rolled to the May. So the rest of the hedges probably are right around in here, but you had a profit from the March on top of that. So we rolled at a good spread basically. All the same, depending on where you got in, where you got out, we're probably talking maybe, it's going to depend on how markets trade, but I would say we'll just let that come out next week, but maybe a quarter profit on that position is how it'll come out. Now, what's so tricky about the corn market is that we are in no man's land. This is support, and you could tell that when corn fell under the 200-day moving average, it did not stay there long. It bounced right back. But it also, a lot of times, it would maybe trade up to the 20-day moving average ahead of a report. It couldn't even make it all that way. It kind of ran out of steam on the way back up and not sure what's going to happen. Personally, I think we're probably going to see a fair share of the trade during the next week or two. I think we're going to see it between this support level and this resistance level. So between the 200-day and the 20-day. So I don't know exactly what it'll look like, but maybe something like that. The net of it will probably be positive. And then support and resistance will approach, and we'll get that, kind of that coiling effect, or that spring effect, where is it going to break to the bottom, or is it going to go to the upside? And we have headlines to deal with, but we also have spring. My bias is it probably breaks out the top because spring comes in. So I'm not saying we get a runaway market to the upside. Why are you stepping in while we're in no man's land and recommending taking profits on the hedges and re-owning? Why are you doing that? Well, number one, we've got a winner on the hedges, so let's put that in our pocket. And if this market takes off to the upside, if we get a friendly report, not really what I expect, but we get a friendly report, market just absolutely goes astronomical. Hate to have hedges underwater that were good hedges that we had a profit on. but I'm not sure it comes back down until sometime after the weather risk in the spring. So at this point, when it rallies, it doesn't necessarily seesaw up and down. We could get, we get a friendly report, then we get delayed planting, then we get a bad growing season, and then it's May 15th or 1st of June, and markets say, well, there's not enough corn around, Brazil's out of corn, and they had crop failure, and the US couldn't even plant it, and we just get that astronomical rally up. It doesn't have to fall down now if it starts rallying. Seasonally, a lot of times, if we get a friendly market in March, it just gets better and better in April and May. A lot of times that happens. So I would hate to give up hedges, and I would hate to not have some re-ownership on if that happens. That being said, what I kind of expect is a little bit more of this seesaw, right? I think we'll have 2 or 3 weeks to layer into these sales and to layer, average into this re-ownership. I think we'll be able to get work done at similar price levels for the next 2 or 3 weeks. And whatever kind of this average is in March, the thought is if this market on corn breaks out to the upside, we just want to be making sure we're taking profits on these hedges. Yes, making sure we're layering into some re-ownership on lower priced corn, absolutely. But let's do that slowly so we're well positioned for the spring. That's the thought process. Not trying to outguess markets, not trying to outguess the USDA. But by the end of March, I would like for us to probably, depending on how markets trade, be pretty solid in our re-ownership. And, not really we don't want to be short coming into a seasonal high spring rally. So it's just kind of getting the work done a little bit at a time. We'll go over the July markets, but it's very, very similar. The chart looks very similar, and it's just kind of bouncing back. So again, we had hedges on, it's probably, again, 20, 25 cents, depending on where you get in and get out. If this market tanks on the USDA numbers, maybe you'll get a little bit better number, but hedges around this $5 mark, and then we're right around in here. Every little bit helps, keeping those wins. Now let's go to kind of a summary. Let me pull up pull up our notes here for us to just summarize markets and wrap up this week's video. No questions this week, so we're going to be skipping the question part. Seasonally, it's a sell on corn because we start getting weather risk out of Brazil. Managed money is actually still technically justifies selling, but they've fallen enough to where it's kind of iffy, right? Corn is in a downtrend. Soybeans are seasonally in a buy. Managed money, they're technically sold, but it's not a big enough sold position to justify buying or selling. And beans are in a downtrend. Beans are actually pretty heavy. They need something friendly. Now let's record this. Soybean basis is trading under historic averages in much of the Corn Belt. Seasonally, we don't expect friendly soybean basis levels at this time. But the big crop out of South America is hurting our cash markets more than usual. Corn basis is tracking at or below typical seasonal levels in most of the country. Basically, there's nothing exciting happening in basis. And And so that I haven't even talked that much about basis because that's not really the story. If you need to move grain in this situation, there's not, I mean, what are we going to do? You got to move it. Basis isn't going to bring great opportunities seasonally at this time. So what are we going to do about it, right? Seasonal opportunities for basis are ahead of us. Technical considerations. Soybeans had a key reversal that may indicate more bearish trade. However, technical analysis just before USDA reports should be taken with a grain of salt. Corn market found support at the 200-day moving average, but could not bounce up high enough to test resistance levels. At present, it seems corn is somewhat stuck between the support of the 200-day moving average and the resistance of the 20-day moving average. The USDA report today could tip the scales, but in the absence of major headlines or adjustments on this week's report, I expect sideways trade may characterize the corn market in the upcoming days and weeks. That is the basic summary of what we wanted to go over. Quite a bit of action to take. I would just make one little caveat about the action. We have a USDA report today. Corn is in no man's land. Beans are, although there's not recommendations on beans, but they're struggling. On the bean market, I'm basically just looking for an opportunity where we feel a little bit of a solid footing to increase our reownership on Q4 beans, and honestly, we're probably just going to have to sell, play catch up on our Q1 beans and just reown that. But I'm not saying I'm hoping for lower prices on beans, but I am hoping for some degree of support. We need to find support because honestly, with weak basis, if bean futures were to go down, we might see an uptick in bean basis, which would help us move some of this inventory. If we would fall to support, then we can average in. We've started reowning some beans. Well, we reowned some Q4 beans, took some profits, reowned some more. We're a little underwater on that. We're waiting to average in. So I'm not saying I'm rooting for lower prices on beans, but if we could find solid footing, that would help us. The caveat that I wanted to say on actions this week, I would play the game of averages. And what I mean by that is we might see volatility in today's market, then we might see volatility in tomorrow's market. I would just kind of play the game of averages and just say, either I'm going to let the dust settle and then Thursday, Friday, I'm going to get into something, or I'm just going to do a little bit each day so that I can get this position. But I would kind of just take it one step at a time, maybe do a little before the report, a little after, or honestly, I'd probably just let the report come out and then just play the game of averages and try to layer into these positions. Don't think about, oh, this day was better, that day was better. This is a multi-month plan. We're doing annual grain marketing, so it's probably going to feel a little tough this week. It might feel like, oh man, I got in perfect, but just play the long game, play the game of averages, layer into these positions. That's my recommendation. And let's see what the USDA publishes, right? That's always a hold our breath and knock on wood, hope for a healthy, friendly report. All right, have a great rest of your day. Great rest of the week too.